Hi, I'm Beth Davies, president of Taxes Untangled, a CPA firm operating in Ocala and Gainesville, Florida. This is the fourth part of our entity selection series, and we'll cover S corporations. An S corporation is the most common form of doing business as far as separate entities are concerned. In my opinion, it's generally the most advantageous for small business owners once they reach a certain benchmark in profitability. I don't usually recommend it until they reach a certain point. To be treated as an S corporation, all shareholders must elect to be treated as such, and you then have to receive approval by IRS. To elect the S status, you have to file Form 2553, and it must be completed and filed with the IRS within 75 days of incorporation or your new fiscal year or calendar year. There are limitations on how many and who can be shareholders of an S corporation. Generally, it's limited to 100 shareholders, and they can only be individuals or estates. There are a few other options, but I would recommend getting professional advice before you look at that. You want to make sure you do it correctly. As mentioned in the other sections, the S corporation must obtain a federal ID number, an FEIN, apply for the state and local licenses, register for your sales and use tax if applicable, and file an annual report if formed within the state of Florida or whatever is required in your particular state. Owners of an S corporation are considered employees of the business and are required to receive reasonable compensation for their work. What is reasonable compensation? That really depends on many factors, such as the industry you're in, the number of hours worked, duties performed, lots of things. So there's no pat answer for that, but you are required to pay reasonable compensation. Since owners are employees, quarterly payroll returns are required to be filed and taxes paid through the EFTPS system. That's Electronic Fund Tax Payment System. If the owners are greater than a 2% shareholder, which most small business owners are, then there are certain limitations that come into play as far as how health insurance premiums are handled and some other fringe benefits. Those will be covered potentially in another video series. The S corporation files annual income tax returns reporting all the revenue and expenses of the business. It doesn't pay any income tax. All the profit flows out to the shareholders in their percentage of ownership. So the owners pay the income tax related to the profit. That's referred to as a flow-through entity. There are strict rules regarding the distribution of profits matching the percentage of ownership. Most sole proprietors elect to be taxed as an S corporation at some point because it limits the self-employment tax that's paid. In a sole proprietorship, all the profit is taxed for the self-employment tax, but in an S corporation, only the wages pay the Social Security or Medicare tax, and the remaining profit is only taxed for income tax purposes. That's the major reason an S status is elected. So that's the brief overview of the S corporation. As always, please seek advice from an accounting and tax professional. The operation of your business is too important to be done as a DIY project. You need to do what you do best in your business and leave the tax and accounting to professionals. It saves you time and money in the long run. Please contact us if we can help you. Thank you.